So I have a bit of history with this company, Innovative Food Holdings. I think I started buying shares in this company almost exactly 10 years ago. And I acquired a position. It was the previous management team. I filed on it as a 5% holder. I think 2 days later, Denver Smith, who's with us over there, he's now on the board. I think he filed 2 days after me. And back then it was the same company, it's just a different management team. And it's right now kind of a turnaround story. I mean, the business hasn't changed too much. It's a classic turnaround where a new qualified management team has come in, led by Bill about 18 months ago, and also led by the chairman of the board, James Pappas, who's an activist, also has his family office. His family's wealth was mainly through, in the food industry. And so he has a keen intellect when it comes to the food industry, and he's been a big asset to the company. And so they ended up selling off some non-core assets. They're in the process of doing that, right-size the business, trying to increase the margin profile, get back to profitability, basically stop doing all the things they shouldn't be doing to focus on the profitable core business that's there. And Bill's done a tremendous job. The stock has reacted favorably in the last 18 months or so. And I think this is probably one of the first presentations you've done. So it's an honor to have you here.
All right, good to see everyone. Thanks for having me this afternoon. It was really impressive to hear that 8 out of 10 people need some kind of eye correction. I did a survey over lunch, and 10 out of 10 people eat food. So as excited as I am about the kits business, this is even more applicable business, just joking. We've got the obligatory forward-looking statement slide. But I want to tell you a little bit about the industry we operate in and what we do as a starting point here. So a lot of what happens in our industry happens behind the scenes and people don't see it. We all go out to restaurants and enjoy a nice meal from a great chef and don't put too much thought into how that food got all the way to our plates. Most of this industry is fulfilled through broadline distributors like Sysco and US Foods, or the big trucks that we all see on the road all the time. And we've laid out here a bunch of the different kind of restaurant segments. And what was really impactful to me is the sheer market share that these two players, the third would be called Performance Food Service Group. Across those three, they have well north of 50% of the share of the entire restaurant industry, right? So it is fairly dominated by these three, but you can think of broadline distributors sort of like the Walmart of food service distribution. They're very good at selling core commodities very cheaply. They're not very good at finding, warehousing, and selling more unique products that especially nicer restaurants might be targeting. So the place that they really lose market share is anywhere what we call in the green a specialty distributor would play. So in retail, you might think of this as like the Radio Shack of retail, right? They're always going to carry a broader assortment of maybe I shouldn't have used somebody who's bankrupt, but they carry a much deeper assortment of a single category that back in the day, at least, you would have felt confident going there knowing you could get things that maybe Walmart didn't carry, right? That's sort of what these specialty guys do. And if we'd showed you sort of a Pareto curve of how many competitors there are in the green there, it's literally thousands across the country. And if you look at any given restaurant type, like we're kind of laying out here, everybody orders some amount of their food costs from the specialty distribution channel because you could never buy everything that you need as a restaurant from those broadline distributors. So if you add up all the green there, it's just shy of 300 billion is the size of this industry that we're competing in, and which means there's lots of opportunity to do things in a unique way and in a special way. So what do we do within this space? We allow our distributor partners to extend their range without any inventory risk while speeding up the entire supply chain and the freshness that they can offer. If you think about most of these broadline distributors, they have dozens or hundreds of warehouses across the country, but all those carry 25 to 30,000 items, right? So they're very focused on those items that are turning fast and are of the right kind of profitability profile for them. We start by saying, what do these broadline distributors not carry, right? What is something unique that we can stand for and actually help them extend their assortment? So here we've just got a few pictures of examples, but we're highly focused on fresh here in the last year since I've gotten here. So we've brought on board some awesome seafood producers. We just onboarded one out of Alaska, a Wagyu beef producer, small mom and pop suppliers many times who don't have a large market for their products and love the idea of being able to sell in more of a national sales channel. So we pride ourselves in finding these little guys who have a unique business model, a unique product category that we can help them explode onto a national scene. We take that sourcing effort and we plug it into the IVFH platform. So there are really kind of three types of supply chains, I guess, that we flow these products through. The majority of our business comes through our dropship program where we don't touch the inventory either. We actually forward orders that are coming from our distributor partners straight on to our vendors who in turn ship directly to the restaurant. So we cut out all the nodes in the supply chain. There's no warehousing. There's no inventory risk. There's no bets that we're making on certain food trends. We're really partnering with these vendors to ship product directly to restaurants. We do own 2 warehouses, so one in Chicago, which does about a quarter of our volume, and then one in Pennsylvania, which does slightly less than that as well. Both of these are what's called SQF certified, which is the highest certification available in the food distribution industry, which is important because our high-end distribution partners are looking for that kind of a certification. So we take this platform then, and then we sell it through 3 main channels, but really I keep referencing this broadline distributors because that is 70% of our volume. So partners like the US Foods and Sysco's of the world, some of these other ones you may not have heard of, but we just recently announced a partnership with Cheney Brothers. Our first new customer partner in, I think we said 6 years. Since I got here, that's been a focus in trying to open up new partnerships. Gordon Food Service is another large one. I mentioned PFG earlier. We also, though, have small and growing businesses with the airline caterers. So you might have seen the Gate Gourmet trucks pull up to your airplane on the way here. LSG Sky Chefs is another of the big caterers in that space. That's an interesting one because while they do a lot of throughput, it's all in small batches, right? It's sort of one airplane at a time. The flexibility and speed that we offer is critical to these guys because they can't miss a plane, right? So they actually rely on us even more so because of that speed and flexibility that we can offer. Then increasingly, we're trying to grow this direct-to-chef model where we've got a business on Amazon, but we're even we own a distributor in Chicago called Artisan Specialty Foods, which is the small logo in the bottom right, where we actually have trucks, we have a warehouse, and we're distributing straight to restaurants in the Chicago area. Lots of opportunity to actually own that end customer and sell our products directly to them. So that's sort of an overview of who we are and what we do. Hopefully that is clear for you. I want to give you just a little bit of a taste of the kinds of suppliers I'm talking about when we say these kind of small mom and pop type vendors. A lot of times these businesses have been owned in the family for multiple generations. There's one we just onboarded in New York called Razzo Seafood. They supply all of the top restaurants in New York City. If you've eaten at any of those restaurants, you're probably eating seafood from Razzo Seafood. He has no business outside of the city. So by onboarding him onto our platform, we're now giving him exposure to a national audience, and he's thrilled with the opportunity to open up that customer base. The guy on the right there, the one that we're working on, Chef's Garden, love that bow tie. He does produce. Sort of unique produce is difficult to source for any restaurant. Think of like microgreens or strange and unique fruits and vegetables. Would never come from a broadline distributor, and depending on your market, could be incredibly hard to access. So things like that are what we're constantly going after and finding success with.
What kind of fish is that one like?
I should know that, and I don't off the top of my head. I'm sorry. He is based out of Alaska, though, so that's something I haven't specifically tried before. So when I came in just about a year and a half ago, I brought in a friend of mine, Brady Smallwood. We've worked together for the better part of a decade across Walmart and Kroger. So somebody I trust immensely and who I've built a long history with. Gary Schubert, we knew, both Brady and I, from our Walmart days in the finance function there. Also tremendous amount of experience and brings really up levels our entire financial function for us. Me specifically, I've spent my career in retail and CPG. So most recently, I ran the e-commerce business at Kroger. It was about a $10 billion P&L. I laugh when I tell people I just had to shave like 3 or 4 zeros off the numbers when I got here to sort of wrap my head around what was a significant number to pay attention to. Before that, I worked in e-commerce with Walmart, and then back at their headquarters in Bentonville, I ran pricing for Walmart. And then before that, General Mills and SC Johnson. So all three of us sort of have big company backgrounds. It's been really fun to come to a smaller environment where we can be a lot more nimble, not have the bureaucracy that we'd all sort of gotten used to over 20-year careers in big corporate America, and be able to make sort of the pace of change that we're excited about. Really got a tremendous board as well. So James Pappas, member of the Pappas family, if you've ever eaten at the restaurants in Houston, Pappadeaux and Pappas Brothers and Pappas Everything. He's a phenomenal chairman for us. Himself runs a large investment fund. Denver, we mentioned, is here actually with us today. Jeff Graham wrote a book on activist investing and tremendous contributor to the board. So anyway, very excited about the people we get to work with at the board level, and I think has made a tremendous difference in helping us chart a path and having a trusted group of individuals that we can lean on. Okay, so what have we been focused on? We've really laid out a 3-phase plan to turn around the company. I haven't talked a lot about kind of the history of where we've been, but the prior management team had focused a lot on building out a consumer-focused specialty food business. Over the last 5 years since the first acquisition was made there, the company's lost about $12 million. So that's been a lot of our focus in the first year and a half has been figuring out which of those businesses need to be transitioned, sold off, closed down, and refocus on the core profitable business. So in this first phase, we call it stabilization. As we think about just getting the company back to a healthy point where we can be proud of its performance and stop raising capital, frankly. In our early days, we spent a lot of time just fixing pricing and margins. We found overall the inflation that had happened in the economy, I think it was 2022, the company lost 400 basis points of margin because they weren't doing anything to manage all of that inflation that was flowing through. We did that in my first 3 months in the role and are now back to positive margin versus where we were 2 years ago. A lot of work on right-sizing SG&A. So we have a third less headcount today, about 100 people, than what we had when I started at about 150. I mentioned exiting unprofitable businesses. We've sold off 3 different entities. We've closed down 2 other entities and are in the process of selling that last big kind of consumer e-commerce business that I mentioned before that's been the cause of so much of the losses. We've been selling off hard assets that either weren't necessary or that we could reconsolidate elsewhere. So we already sold our Florida headquarters building for about $2 million. We have our Pennsylvania warehouses on the market now. We'll likely do some sort of sale leaseback or consolidate our operations to Chicago once that transaction hopefully goes through at some point. Our only loan as a company is about a $9 million loan against that Pennsylvania warehouse, and the goal is that once that sells, our current asking price is $18 million, so well in excess of the debt on it. The plan is to pay off that debt and be debt-free as a company, which will be just a phenomenal place to be in. With that extra capital that we'll get then out of the Pennsylvania building, our goal is to just refocus everything on what we call the professional chef business, which is everything that I talked through a minute ago. food service through US Foods, Cisco, and those other sales channels, and to not focus at all anymore on our consumer business where we've lost so much money. We're already reallocating people and focus as a company. We just had our leadership meeting a couple days ago, and I walked away just feeling so excited. We didn't mention the consumer business once in a 1-hour phone call. And it was just awesome to hear everybody's ideas and all the progress and everything that's happening on the food service side of the business where we've already got a profitable business model. So phase 2 that we'll begin to move into here shortly, we're calling Build the Foundation for Growth. So once we've got a stabilized, healthy company, we're going to start to look a lot more into the future on where we want to go. And what I really want to do is spend some time testing out and establishing our long-term business model. So I sort of laid that out for you on a few other slides, but there's a lot of different directions we could take the company from here. And during this phase 2 is where we're going to put a lot of lines in the water and test out where we think the best growth potential and profit potential is for the company. We're working to add new dropship customers. I mentioned Cheney Brothers. We also announced recently that we've started a new contract with one of the top 5 broadline distributors in the country. So a lot of focus on new customers within that already profitable business. We're ramping up vendor and item growth. That's really the biggest secret sauce we have is our ability to vet, train, and onboard vendors and items quickly. And so we're ramping up our efforts there and adding new vendors again for the first time in several years to the business. And then also during this time period, we're going to be reinvesting our savings and profits into small tuck-in M&A that can help us to sort of test out these hypotheses that we're looking for our long-term business plans. So we're being very thoughtful with these initial potential acquisitions. We're not going to bet the farm. We're not going to get out over our skis. We want it to be self-funded. We don't want to raise capital. So these are, I lay out here, EPS accretive, less than a 5x multiple, less than a 5-year payback, all of that without including synergies in the model, because we want to have clear synergies that we can sort of have the spoils from, and I mentioned without any dilution. During this phase, our goal is to get to $100 million in revenue. We were $72 million last year in 2023, so we have a ways to go there. But the goal is $100 million in revenue and $10 million in adjusted EBITDA. The company's never done either one of those numbers before. So I think it will really, once we hit those goals, it'll be a really important milestone as to the long-term direction of the company. And then this phase 3 we're calling Grow and Scale. It's intentionally quite empty because we will be leveraging the learnings that come out of phase 2. The hypotheses we're testing, the tuck-in M&A that we've made at that point will be clear which of those strategies worked and which direction we need to go. But the important headline here is that we're not trying to build a company that's going to go from 100 million to 150 million. We want to build a billion-dollar company. If you look at the management team, we've all come from that kind of a space, and we want to really be able to put our stamp on something and make that kind of progress. So how's it gone so far? Revenue intentionally has declined over the first bit as we're right-sizing our customer relationships, as we're right-sizing the businesses that we have under our belt. We've said that we expect our revenue to get back to year-over-year growth in the back half of this year. So you can continue to look for that progress from us. I mentioned gross margin. We're back now to a couple hundred basis points of growth over where we were in 2022. Still have opportunity there that we're being thoughtful about, but great to see the progress on margin. Of course, then our adjusted EBITDA has responded as we've fixed both SG&A and gross margin, and think we, with our $10 million goal, have significant headroom and opportunity there still as well. And then, of course, our financial leverage has come down significantly as we turn profitable and start to make progress there. So try to put this all on one slide now to help encapsulate for you what we're doing. We're really trying to divest and get rid of, close down anything that's unprofitable or declining for us, and take all of that cash that we generate and plow it into our profitable professional chef business. So We're removing distractions. We got rid of our retail brand management business, our food service brand management business, several fulfillment and marketplace partners that were sucking up time and not driving any profit for us, and putting everything into that professional chef business like we've talked about. And that's eventually what will get us to that $100 million in sales and 10% adjusted EBITDA. And then lastly, the stock has performed well. As we've been explaining this plan to investors, we had our first earnings call I think it was last August. The first earnings call the company had had since 2016. So we've really tried to be a lot more transparent and open with investors than what has happened historically. If you look up on our website, you'll see a regular cadence of press releases, and this being our first presentation, we just posted this morning. So we really are passionate about making sure that we have open lines of communication with investors, and I'd welcome anybody who's interested to reach out to me directly. I'm happy to have those conversations wherever it makes sense. We are at a $75 million market cap now. It was at $12 million when I was negotiating my contract, and I think we were on the day before, it's right there, 25 cents the day before my announcement came out. So we're excited with the progress we've seen, but just getting started and excited about the path forward. So that's what I got in presentation.
Okay, I'll ask two questions and then we'll open up to the audience. Maybe the first question I think a lot of people think of when they think about your company and they hear it for the first time is, you work with three of the top 5 broadliners here in the U.S., food distributors. And why aren't they doing this themselves? Why can't they, or why don't they?
Yeah, so the reality is they are. They all have their own marketplaces now. That's really just new in the last couple of years. And it's still too hard for them to manage at the kind of detailed level that we can. They're generally focused on bringing on players that have 300 to 500 SKUs and are established in the market already, right? I showed you some of the suppliers that we work with. It's on a much smaller scale than what the broadliners would ever do. And so we add a lot of value in being able to find those vendors, vet them for food safety. We have a whole process we take them through that makes sure that they're up to the standards that a restaurant ordering from US Foods or Cisco would expect. We train them on how to package product and get it shipped across the country within temp state. It's funny that one of those new seafood guys we brought on, we had him send us his first set of samples, and it literally arrived at our sourcing guy's house dripping fish juice out of the corner of it, completely thawed and in bad shape, right? So we knew we had some work to do there. But US Foods or Cisco is not going to put up with that kind of stuff, right? We hopped on the phone, we talked them through how to avoid void in the box and the correct kind of packaging materials, how much ice he needs, and then tested it again and came back much like that. That's the kind of hand holding we do with these guys, and I think that's a lot of our competitive advantage is the willingness to get to that level of detail and then be able to do it at scale.
So your ability to find and locate thousands of these unique producers of artisanal foods, and then being able to provide that to a broadliner as a drop ship option to their chef customers.
Exactly.
And
yep.
Can you talk a little bit about kind of the asset light nature of that? How many people do you have to add to go from 50 million to 70 million?
Yeah, no, I'm glad you brought that up because I probably didn't focus on it enough. The beautiful thing about a drop ship business, I mentioned no inventory risk, but you also don't own trucks, you don't own warehouses, you don't have people moving boxes around that are scheduled for hours that you may not need, right? All those things are gone. So we really, for that 55% of our business I mentioned is all drop ship, we have a 4-person customer service team. We have 1 person that does logistics with FedEx, and we have 2 people that do sourcing. And that's the entire business, right? So as we add additional broadliners who themselves have thousands of customers that we bring on, there's really not a lot of overhead that we have to. We add a salesperson to manage the relationship with them, and that's about it. So that to me is the huge opportunity here is that side of the business can scale indefinitely with no capital investment, no marketing expense, right? Because we're actually leaning on these broadline partners to market the program to their customers. We're not out there spending tons of money. It's a lot more based on relationship. We have to train their salespeople to be good advocates for us, but it's nowhere near the same as if you're spending out on Google and Facebook and everything, right? So yeah, that's a pretty exciting part of the business. I look though too at our acquisition we made in Chicago a decade ago, Artisan Specialty Foods that I mentioned. We essentially doubled the size of their local distribution business because we gave them access to these other sales channels, right? So as we look at M&A, that's part of the opportunity, is to take somebody who's only competing in a small local market and overnight double their business by giving them access to a much broader set of sales channels. And again, the infrastructure is already there. You've already paid the capital for it, but then you get incredibly higher throughputs through a fixed asset like that. And we think there could be pretty cool returns there too.
Okay. Any questions?
I guess I don't call them people. Somebody else does.
Thanks for the presentation. It was awesome. I'm trying to understand the stickiness with, so when you go find a new producer that you guys want to add to the platform, is there, if they agree to go with you, is there then exclusivity where they're only selling through your platform? And then specifically with the dropship side of the business, you're making the connection, and then they're sending that product out. Like what stops you from getting circumvented once they're kind of introduced to the endpoint?
Yeah, that definitely happens, and it's part of the nature of the food service distribution business. Everybody's always trying to get closer to the source, and it's why it's so important that we have a strong, call it like conquesting activity that's always going on. We always need to be at the forefront of the next food trend and finding who's at the nexus of producing that trend and can do it at the right cost for us. So there's definitely always a risk on the vendor side that we lose somebody, but we found that because of the way that we train and onboard them, we create a loyalty that is pretty unmatched. Most of these people we do business with on the vendor side, they've never done anything like this, right? They're fourth generation Alaskan fishermen. They've never sold anything online before, and they don't really want to. So the easier we can make it for them and grow their sales, they're not even out there looking to find more partners. They're super happy that their business is growing 20%, and they literally just get a pack of 10 orders a day by email that they have to process on their own, right? So I think there's probably far more stickiness on the customer side, on the broadliner side, because these are tech integrations, right? Once you get integrated with somebody, that's not something you walk away from in a quick way, right? You build a deep relationship with these broadliners. We've had them sometimes go around and steal a vendor from us, and I tell the team all the time, that's part of this business, right? That's why we got to be out finding the next cool vendor. That means we've been successful. If we've actually gotten somebody to the point where they're doing the volume that US Foods wants to come steal that vendor and bring it into their warehouse, then we've done our job, right? It's time for the next vendor that we can go find and keep bringing those specialty guys to the forefront. Yeah.
Yeah, thank you again for being here. It's great to have this conversation in this format, so thank you.
Sure.
And I think I heard you mention there are 2 distribution agreements you signed recently. Could you help think through or talk through the expectations of how quickly they should be ramping, and then what the scale might be relative to $100 million of eventual goalpost? Yeah,
so we have to report publicly the size of our US Foods business because it's gigantic. I think in our last Q, it was right around 50% is our revenue that goes through US Foods today. So that's obviously, if I'm in your shoes, that's a risk, right? That nobody wants to see a company with that kind of concentration in one customer, which is why we've really pushed, finding new sales channels and customers recently and since I've gotten here. But I mean that, at those numbers, that's a $35 million business for us that took 20 years to build. I think if you look at the other contracts we've signed recently, we should be able to scale them much faster than 20 years, but it's not something that happens overnight either. There's definitely a sort of an education process that happens. I mentioned like partnering with their salespeople to get them excited about the new prospect of having all this incremental assortment that they can sell. But there's a ramp period to that. I mean, I like to in my spare time, look at our business as a percentage of US Foods' total business and think about how these other new partners could scale. But I'm looking at it as a multi-year type scaling process, not a 6-month type scaling process. Go for it.
And again, back in the phase 2, the 100 million revenue, 10% adjusted EBITDA, could you just talk through what adjusted means and how much DNA there might be, to whatever degree you have some type of clarity on those moving parts?
Yeah, so 2 quarters ago, we started putting in our press release a super detailed breakdown of the adjustments that we make, so that you all have clarity. And it's not sort of something that we're changing every quarter based on where we want the number to land. We're now super consistent about those adjustments and clear on what comes in or out. But they're all the things you would expect. There's stock compensation and one-time severance costs, which we've done a lot of over the last year. Things like that are the core adjustments. What I'm trying to measure with adjusted EBITDA is the core operation and how we're actually running the business. Because as I look at the 10 million we want to get to, that's part of how that 10% rate is part of how we're thinking about the businesses that we're choosing to divest and the ones that we're choosing to build, right? I want any acquisition we make needs to be accretive to that number. Any new business we go get needs to be accretive to that number, and that's the kind of healthy business that I want to create in the future. Does that answer your question? What do you mean the DNA? I'm sorry. Oh, I was thinking DNA, like, got it. Yeah, that's definitely in the adjustment. I mean, between the only assets we have are the Chicago warehouse and the Pennsylvania warehouse, and then the few trucks that are associated with the Chicago warehouse. So they don't make up a tremendous amount of the P&L today. As we make other acquisitions, that could change, but in the current model, that's not a tremendous amount of the adjustments.
Maybe to follow up on the M&A side, can you talk
Yep.
about sort of the M&A funnel, what you're looking to acquire and why?
Yeah, so there are, I'd say our biggest focus of the M&A is, I was sort of alluding to it earlier, but I'd like to find some small distributors that we can put into our other sales channels and massively expand with their existing infrastructure. Bonus points if we can find ones that are in categories that we don't currently compete and can dramatically sort of incrementally grow the type of addressable market that we could go after. So I think historically most of our assortment is focused on imported goods from I'd say mostly Europe and the Middle East. And so, anything outside of that, I think, is going to be a huge opportunity for us to do something new and incremental and grow our existing sales channels. But if we can, like I said earlier, if we can plug a player like that into the platform, right, and overnight we're selling to US Foods and Sysco and Amazon and then even in local Chicago in our business at Artisan, then you're doubling sales and profit in a short period of time. That's a pretty compelling strategy that you start to run as a roll-up, right? And most of the big distributors, the US Foods and Sysco of the world, they've all grown through a roll-up strategy over the last 20 years. I mean, they're all 10x the size they were 20 years ago because they've been going market by market and acquiring the traditional broadline regional distributors. So it's not like a rocket science strategy in this industry. I think what we could do uniquely is focus on specialty players that are of a smaller size because we already have these existing sales channels that we can plug in, right? It's less about the customer acquisition in that market and more about the way we could explode the sales channels that they have access to, and that'd be sort of the synergy that we bring to each one of those acquisitions.
Any other questions? Oh, one more. Shy. Is that shy?
I don't know if it's relevant to ask, but I'm curious anyway. Shore Capital specializes in small nano cap private equity, and they are very aggressive in buying things that are of the same size as you guys trying to buy stuff. How many other possible buyers do you think you compete against when you try to find targets to acquire? So not a fragmented endpoint, but how many other buyers would be in the same landscape that you're?
Yeah, I mean, I think for this phase of our strategy, we haven't had a lot of competition for the ones that we're talking to, and I think what we're finding is that several of them have already been approached by, like a Chef's Warehouse is probably the largest specialty distributor in the U.S., and many of them said no because they didn't want to become part of like a corporate behemoth. And so I think a lot of it is going to depend on our, less on our size and financials and more on like our management ethos. And where we've so far made a lot of progress with those current business owners is the idea that like we don't want to come in and ruin the culture. We actually want it to be its own little entity and just be able to bring these new sales channels to them. So I think, as we sort of hone that sales pitch to these small distributors, my hope is that it's not about price, it's not about, competing against others out there. It's really about creating something bigger and more exciting that those owners can be a part of.
Okay. Thanks, Bill.
Cool. Thanks.